Okay, we had part 5 of the bank simulation user manual. It is capital management, credit rating, and share price. Capital adequacy is the first section. These ratios compare the bank's total capital and Tier 1 capital with the total of risk-weighted assets and off-balance sheet items and the market risk associated with the trading portfolios. Capital consists of primary capital and secondary capital, also referred to as Tier 1 and Tier 2 capital. Tier 1 and Tier 2 capital comprise of the following. Tier 1 is equity, which is ordinary share capital plus their reserves. Tier 2 is subordinated debt. The minimum requirement for the capital ratio is 12% of risk-weighted assets in capital. The bank has to have a minimum Tier 1 capital ratio of 9% of risk-weighted asset. That means at least 9% of risk-weighted assets must be covered by the primary capital and the other 3% by secondary capital. For the purposes of calculating the capital adequacy ratio, which is CAR, Tier 2 capital must be less than or maximum equal to the Tier 1 capital of the bank. The following regulatory requirement on capital has to be adhered to. The amount of subordinated debt must be less than or maximum equal to 50% of the total equity Tier 1 capital of the bank. The next section was risk-weighted assets. Basel II Capital Accord is an international business standard that sets the risk-weighted assets due to its coordinates. To figure the risk-weighted asset, the applicable risk weight is multiplied by the sum of all asset totals. To meet the minimum capital requirement, at least 12% of the sum must be covered by the bank's capital. To meet the Basel II Capital Accord requirements, the weights are as follows. Cash and government securities, 0%. Interest swap rates, 1%. Commitments, 20%. Interbank loans, which is AA rated, 20%. Mortgage loans, 35%. Prime loans that aren't rated, 100%. Investment loans that are not rated, 100%. Retail loans, 75%. And other assets, 100%. Primary capital is next. Primary capital is made up of ordinary share capital and the accumulated reserves of the bank. The new share may be issued at the current share price as calculated at the end of the previous quarter with an underwriting discount of 5%. As the underwriting discount is not amortized, there are no effects on the income statement. The underwriting discount will have no effect on the income statement. Issue costs will reflect under operating expenses for these new shares, but in the simulations, these costs will be written off as expenses for the quarter. The bank will use this capital to generate revenue while also using it to maintain its lending and deposit operations. Secondary capital or subordinated debt. Subordinated debt is the type of secondary or Tier 2 bank capital. There are many forms of subordinated debt. These are debt financial instruments that the bank issues, including bonds and long fixed or variable maturities and convertible bonds. The payment of these claims of the debt holders are subordinate to the claims of depositors. Such non-equity accounts are allowed as capital by regulators because they carry relatively long-term maturities and the creditor's claim are subordinated to depositors' claims. Only debt with an original maturity of 7 years or more qualifies as secondary capital. Such funding sources enhance the bank's solvency and protects insured depositors and the insurance funds providing depositors insurance. While counted as capital, subordinated debt does not qualify as Tier 1 capital because, unlike equity capital, it has a maturity date and imposes interest expense on the bank. Advantages of subordinated debt banks include the tax deductibility of interest payments that the ownership stake of current shareholders is not diluted. A disadvantage is that interest in principal payments must constitute default. Credit rating was the next section. At the beginning of the simulation, the bank will start with the same credit rating. From quarter to quarter, the credit rating varies based on the strength of their capital. The capital ratio of the bank determines the bank's credit rating. The ratio is also calculated as follows. Total capital divided by total risk-weighted activities. With a minimum of 12% for the capital asset ratio, the following is how to determine the bank's credit rating. 50% and above is AAA, 30.00 to 49.99% is a AA, 18.00 to 29.99 is an A, 15.00 to 17.99% is triple B, 12.00 to 14.99 is a double B, and below 12% is a B. Borrowing funds from the central bank advance will negatively impact the bank, causing it to suffer, while borrowing from the central bank advances will not cause the bank's credit rating to increase. If the bank has two central bank advances in a row, the bank's credit rating will remain as the previous quarter and will further drop by one notch. An example of this would be if a bank qualifies for a AA rating for the current quarter, according to its capital ratio, and if in the previous quarters the bank's rating was an A, the credit rating of that bank will now be a BBB. If a bank makes a loss, then the credit rating cannot be increased. How can credit rating of the bank be impacted negatively? The credit rating is negatively impacted by a central bank advance. A central bank advance is a result of the bank borrowing from a central bank, which causes the bank to have a bad reputation. The credit rating of the bank will not increase if it has to borrow from the central bank. If a bank should have two central bank advances in a row, the credit rating remains the same as the quarter previous to the advance and then drop one notch further. Meaning if a bank has a current quarter rating of AA and the previous quarter has a single A rating, the rating will again drop from A to BBB. A bank cannot increase its rating in the quarter which has incurred a loss. Last section was share price. A bank's performance is measured on the basis of the amount of value created for the shareholders of the bank. Every quarter, a new share price is determined, and the share price is affected by different variables. These variables can include moving average of initial EPS over 6 quarters, standard deviation of EPS, dividend policy, and credit rating of a bank.